Markets have reached an all-time high once again. It seems like a fairly common occurrence these days. Now, as a mutual fund investor, you could be in one of these three phases broadly, and I'm going to talk about those phases and what you could do at this point of time. So, the first phase is the accumulation phase. That is, as an investor, you are investing at this point of time. It could be through the SIP route or through the lump sum route. Now, when our portfolios are in the green and they're showing healthy returns, we feel good. But it's also important to remember that as markets move up, we are acquiring units at a higher NAV, that is at a higher price. That means we're getting lesser number of units. So as investors, we want the market to be down so that we get more units. Just like buying gold cheaper, we get more grams. However, if our portfolio is in the red all the time, then we may not feel good and we may not feel anchored as investors to continue investing. So at this point of time, enjoy the returns that you're getting, feel good when you open up your report or your app, but let the process continue. Some investors may also feel that markets are at high, I should stop my SIPs and come in at a later time. It's very difficult to time the market and enter and exit at right times. So let the process continue. Even if you're acquiring units at a higher price today, markets will move up at some point of time and give you the benefit. The second phase could be if you're in the holding phase. Now, it does happen sometimes that we're not able to invest more into our holdings. This could be because of some extraordinary expenses that has come up, or we have diverted our funds somewhere else. Even in this case, it is important to leave our holdings as it is. Many people are tempted to book profits and put the money somewhere else. But where will we go with that money? If we go to a fixed deposit or similar instruments, then we are going to earn at a lower rate of return. If we go to invest in shares or commodities or even crypto, there is a possibility of generating higher returns, but it requires us to research, monitor, and then enter and exit at times, and we may not have that time to do this. So it may lead to greater losses. So if you're in the holding phase and you don't have a requirement coming up in the next 1 to 2 years, let your investments be as it is. The third phase is when investors have a requirement coming up in the next 1 or 2 years, and so they're nearing the redemption phase. Now, here sometimes the reverse happens. The investor is tempted to stay and wait for the markets to move up even further. But as you know, it's difficult to time this, and normally a rise in markets is also characterized by a fall after some time. It need not be a very sharp fall, but it's difficult for us to gauge how long it will rise and when will it start falling. So if your funds have delivered a good return, say for example, a large cap fund has delivered 10 to 12% return annualized, or a mid cap fund has delivered 12 to 14% return annualized, then you can consider withdrawing your investment and placing it into a safe fixed deposit so that you can use this when your requirement comes up. Even if that requirement is 1 or 2 years away, it is better to take the money out now. So I hope this video helps you in these volatile times. If you have any more queries, please do drop a comment or write into us at our contact points and we'll be happy to get back to you. Thanks for watching.